we're going to put on our investor hats and really unpack the massive, and I mean massive, structural shifts happening inside Alphabet right now. We'll be debating whether this stock is actually the tech sector's best hidden value. You know, we are looking at a company at a fascinating crossroads here. They're trying to navigate the absolute bleeding edge of artificial intelligence while simultaneously trying to protect one of the most lucrative monopolies in modern business history. Usually companies face a pretty stark choice, right? They either get disrupted by an outsider or they lazily coast on the monopoly until they just sort of fade away. But Alphabet, they are trying to do the impossible. They are aggressively trying to disrupt themselves before anyone else can do it to them. And for us as investors, figuring out if they can actually pull that off is the entire key to valuing this stock. So, here is our roadmap for today. First, the 400 billion engine. Second, shifting gears and growth dynamics. Third, the bull case. Is it undervalued? Fourth, the bear case. What are the rising risks? Fifth, forecasting 2027 scenarios. And finally, our verdict and educational disclaimer.
Okay, part one, the $400 billion engine. Let's look at how Alphabet actually makes its money.
To truly understand where Alphabet is heading, we really need to take a hard look at its present, specifically a monumental milestone they just crossed for the 2025 fiscal year. It is absolutely critical to grasp the sheer, unbelievable scale of the cash this company generates before we even try to model its valuation. Alphabet has successfully transitioned from being just that simple search engine we all used to know into a full-stack artificial intelligence powerhouse. They brought in a staggering $402.8 billion in total revenue over 2025. That's a 15% year-over-year increase. They are no longer just a digital billboard serving you blue links. They are deeply integrating incredibly complex reasoning models, like their Gemini AI, across their entire ecosystem. For the end user, this means Gemini is now out there dynamically drafting entire email chains in Google Workspace, it's coding complex software scripts for developers in real time, and automatically sorting your smartphone's photo library. And when you look at how they actually generate that $400 billion, it's fascinating. Alphabet is fundamentally anchored by Google services, which makes up roughly 72% of their massive revenue pie. This huge slice includes the traditional cash cows, right? Google Search and YouTube advertising. But importantly, it also shows a massive structural shift toward recurring subscriptions. Between YouTube Premium and Google One Cloud Storage, they've recently surpassed 325 million paid subscribers combined. That's huge. Then we've got the second slice, Google Cloud. This is rapidly evolving into a high-margin profit machine, as enterprises everywhere rush to rent out Google's computing power. And finally, there's the other bet segment. This is where Alphabet keeps its long-term high-risk moonshots, most notably Waymo, their autonomous driving company. Waymo operates totally separate from the core ad business, but it represents a massive future total addressable market.
Moving right along to part two, shifting gears, growth dynamics. Now, what's really fascinating about this conglomerate is that its internal engines are running at vastly different speeds. It's almost a tale of two companies. On one hand, we are seeing explosive, unprecedented acceleration in Google Cloud. I mean, it grew at a massive 48% year over year, hitting $17.7 billion in just the fourth quarter alone, and it reached a record 30.1% operating margin. Why is this speeding up so fast? Well, it's heavily fueled by intense enterprise demand for something called agentic AI infrastructure. We're not talking about a basic chatbot here. Agentic AI refers to autonomous AI agents that can execute complex, multi-step corporate tasks. Think of a virtual employee auditing thousands of financial records overnight while you sleep. Running those agents requires an insane amount of compute power, which companies are happily renting from Google Cloud. But on the flip side, this hypergrowth is sharply contrasted against a maturing ad business that actually saw some sluggish Q4 growth. Part of this was due to really tough year-over-year comparisons with late 2023. Back then, APAC-based e-commerce retailers, companies like Temu and Shein, were just flooding the market with ad spend to grab market share. As that crazy spending normalizes, Google's core ad business is naturally showing some signs of cooling down.
But here's the thing. Despite these shifting gears, the red-hot cloud segment balancing out the cooling ad segment, the overall projected annual revenue growth for Alphabet through the year 2027 is holding remarkably steady at 11.6%. Now, I want to pause here for a second because of the law of large numbers. 11.6% might not sound like the explosive hypergrowth we saw in the early internet days, but you have to apply that percentage to their base. For a company bringing in over $400 billion a year, compounding at nearly 12% annually is a massive absolute dollar increase. We are talking about pouring tens of billions of new dollars onto the balance sheet every single year.
All right, part three. Let's talk about the bull case. Is the stock actually undervalued?
Let's step into the shoes of a bullish investor for a minute and ask the million-dollar question. Is Alphabet fundamentally undervalued right now? When you look at the broader market, Alphabet occupies a really distinctive and arguably cheap position. For experienced investors, the crucial metric we want to look at here is the PEG ratio, price/earnings to growth. Think of the PEG ratio as the price tag you're paying for a company's future growth. If you buy a stock just looking at its PE ratio, you're only looking at today. The PEG ratio factors in tomorrow. When we stack Alphabet up against similar Magnificent 7 tech stocks like Microsoft or Nvidia, which might trade at a PEG of 2.5 or even 3, Alphabet's numbers really stand out. With a 1.7x PEG and a 25x forward PE, this shows us Alphabet is trading at a notable discount. That 1.7x PEG implies you're paying significantly less capital for every percentage point of future earnings growth. So you could argue it is the most attractively priced megacap tech stock on the market right now, effectively trading at a lower multiple than companies that generate way less free cash flow.
And bulls argue this valuation discount is completely unwarranted. Let's break down exactly why. First off, you know that widespread fear that AI was going to destroy traditional Google search? It's actually proving false. Internal data shows that AI overviews, those AI summaries at the top of your search results, are actually increasing overall search query volume and user engagement. It keeps users locked right inside the Google ecosystem instead of clicking away to another site, which deeply protects their advertising moat. Second, Waymo just snagged a massive new private valuation of $126 billion after raising $16 billion in fresh capital. That proves their lead in autonomous driving is very real and highly valuable. Third, Alphabet's trailing 12-month return on equity is currently sitting at a 20-year high of 32%. A 32% ROE is absolutely absurd for a hardware-heavy tech giant. It basically means Alphabet's management knows exactly how to generate incredibly efficient, outstanding returns on the capital they deploy. And finally, those expanding cloud margins hitting 30.1% provide just incredible long-term profit upside, as that segment takes up a larger and larger share of total revenue.
But let's flip the coin. Part 4, the bear case and the rising risks.
Because, every massive engine requires fuel and navigation. And that brings us to the severe, very real problems facing Alphabet as we move through 2025 and 2026. The market's hesitation to fully price Alphabet like a pure AI winner isn't just coming out of thin air. Look at these capital expenditure numbers. The most staggering risk here is the sheer cash drain of the global AI arms race. Alphabet's capex was $52.9 billion in 2024. Then it jumped to $75 billion in 2025. And now, they are projecting a massive capex surge to between $175 billion and $185 billion for 2026 alone. Let that sink in. What is that cash actually buying? Well, it's not going to software. It's buying thousands of insanely high-priced NVIDIA GPUs, sprawling physical data center real estate, and massive electrical grid contracts just to power and cool those servers. Bears are terrified that this astronomical spending is going to severely drag down free cash flow. The specific fear here is an ROI delay. What happens if the AI applications they build just don't generate enough new subscription revenue to justify the massive physical cost of the data centers required to run them?
And the bears also point out massive vulnerabilities well outside of just infrastructure spending. Regulators at the Department of Justice are aggressively targeting Google's search monopoly. And listen, this isn't just a threat of a slap-on-the-wrist fine. Regulators are pushing for deep, structural changes. They are potentially seeking to forcibly break up the company by making them sell off the Chrome web browser or ripping apart their incredibly lucrative double-click ad tech stack. There's also heavy concentration risk. Because traditional text-based ads still heavily dominate their top-line revenue, Alphabet is highly sensitive to the broader macroeconomy. If a recession hits, corporate marketing budgets are the very first things to get slashed, which would immediately hit Alphabet's bottom line. On top of all that, there's complex uncertainty lingering around YouTube legal liabilities, especially concerning copyright laws and the data they use to train these massive AI models. So these are incredibly heavy clouds hanging over the stock's valuation multiple. So where does this leave us? Part 5. Forecasting 2027 scenarios.
Depending on which narrative you believe, the resilient AI compounder or the bloated, regulated monopoly, the models paint very different pictures for the stock out to 2027. We essentially have 3 distinct paths mapped by analysts. Path 1 is the bearish view. This suggests the stock is roughly 40% overvalued today, setting a fair value target around $237.43. That happens if that massive capex spending fails to generate a return and core ad growth just keeps slowing. Path 2 is the base case. Here, Alphabet acts as a steady compounder, relying on consistent earnings and massive stock buybacks to prop up value, reaching roughly $275.86 by 2027. And finally, Path 3 is the highly bullish Morningstar fair value model. targeting $340 or even higher. This bullish model heavily relies on a discounted cash flow, or DCF analysis. The DCF model expects multiple expansion to take hold as agent AI monetization rapidly improves. Basically, it means that massive $185 billion infrastructure bet pays off beautifully in the long run.
Part 6, Verdict, and our educational disclaimer.
As we wrap up this explainer, you can see that the massive gap between a bear case of $237 and a bull case of $340 shows exactly why rigorous personal analysis is so absolutely critical. Please remember, this explainer is strictly for educational purposes. It is not investment advice, and everyone, and I mean everyone, must do their own comprehensive research before investing in any company. Market conditions, especially the highly physical constraints of the AI sector, can change in a heartbeat.